And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the second best day of the week. That's right, it's Thursday. Man, this week went fast. It was like Monday was a holiday. So, here we are. It's already Thursday. Everybody's like, right now is like, God, this was the longest week ever. So yeah, we're almost done. And good news, Valentine's Day is almost here. So my wife told me a little hint last night. She's like, I made reservations for Valentine's Day. I'm like, honey, it's like the 5th day of January. So the 5th day, right? Today's the 4th. See, I'm already behind. It's just moving too fast. Anyway, all good. Hey, by the way, Santa Claus failed to visit Wall Street and Wall. Here's the issue. One of the things that we talked about was the Santa Claus rally. Santa Claus rally last 5 days of December, first 2 days of January, and if statistically speaking, right, it's that if Santa fails to visit Broad and Wall, the next year's not so great for markets. And of course, the years that Santa failed to visit Broad and Wall also happened to occur in 2007, which led to 2008, and you get the idea. So we actually started out a nice rally into the last 5 days of December, and we can count those up right there. So there's your last 5 days of December was great. The first 2 days of January took all those out entirely. So we have now negated the entire Santa visit to Wall Street. Now, this comes down to kind of a very critical point here, which is, can the markets rally here over the next couple of days so that we get a first 5 days of January being positive? Well, that's going to be a pretty strong rally here. The market's going to have to muster up after the last day of December and the first 2 days of January of trading have not been good for the market. So you're going to have a fairly strong rally starting today, tomorrow, and Monday to get the markets back above where January started. So we got to get a first 5 days of January going fairly strong here. So again, we'll see what happens. Markets are sitting right on the 20-day moving average this morning. Futures are a little bit flattish. So again, not a whole lot going on here, but we'll see what happens. But again, this has all been kind of part and parcel of what we're talking about here as of late. So we'll see what happens. But also too, the Fed minutes were out yesterday. And that was kind of interesting because the Fed, kind of the speeches from the Fed, from Jerome Powell at least, gave the markets a tremendous amount of hope. So we'll kind of go through those Fed minutes and see why the markets didn't really respond well to those Fed minutes yesterday. After they came out, markets actually kind of sold off some more yesterday. So I'll get with Michael Leibowitz this morning. We'll kind of go through those Fed meeting minutes and see what maybe they might actually be saying about further rate hikes. And more importantly, there was actually some commentary about QT, which is that shrinking of the Fed balance sheet. So we'll get into that this morning also. Outside of that, though, we are about to start getting some decent economic data out. We'll have the employment report on Friday. One of the big concerns is, of course, that labor market. We have seen some softening in the labor market as of late. We're seeing the quits rate starting to drop here, so people are unwilling to kind of quit their job because they're not so sure they're going to get another job. So we are starting to see some softness in the labor market. The question will be, how does that look, for the month of December? Of course, you have a lot of seasonal hiring in there, so that tends to be a little bit stronger month. January, of course, as we get into February, January is one of the biggest seasonal adjustments of the entire year. So, we may see some kind of, volatility around those employment reports here because, again, everybody's kind of looking at those employment reports as for direction as to what the Fed may or may not do next. And right now, of course, the market is pricing in twice as many rate cuts this year than even what the Fed is talking about. So the markets are much more optimistic about the Fed cutting rates and potentially doing QT than what the Fed is actually saying, but that's also been part and parcel. This kind of over-optimism has been part and parcel of this big rally that we've had really ever since those lows back in October. Okay, here's what you need to know before the bell this morning. Yes, Santa did fail to visit Broad and Wall, and of course, this decline over the last 3 trading days has taken out that entire rally that we saw going all the way back to the beginning of that Santa Claus rally. The question, as I said here, is kind of what happens next. And again, the markets are still kind of set up here for a bit more correction. We're still on a solid sell signal right now on our MACD indicator, which is at a fairly high level for the markets. We are finally working off some of that overbought condition. We're not done with that yet. But we are starting to work off that overbought condition. So that is getting to a point to where we could see a little bit of a bounce in the markets. And the question will be, can the markets kind of get their feet back underneath them and start, kind of rallying, for the new year. Again, the first 5 days of January tend to portend to the rest of the month of January. So goes January, so goes the year. That's really kind of the look for the markets right now. Again, not completely oversold here yet, but working off that overbought condition, that sell signal in place. So that may keep pressure on markets here over the next few days, in particular as we kind of work this off. But we are getting finally, that bit of a correction that we needed, to try to give you a little bit better opportunity to put some capital to work in the markets and, in companies that you like. Importantly, though, if you take a look at the number of stocks trading above their 50-day moving average, that's still at a very high level. So despite this correction, we haven't really reverted a lot of that, very bullish backdrop. And again, when you have a large number of stocks trading above their 50-day moving average, that typically tends to equate to market peaks. Again, kind of where we are in the market's kind of peaking here. But again, that doesn't mean you're going to get a big correction. But we could see a little bit more pressure on stocks really kind of across the board. So far, a lot of that selling pressure has been really kind of fostered in the tech stocks that rallied the most last year. We've seen a good bit of pressure in Apple and Microsoft and Tesla as of late. Sectors that have been doing a lot better this year so far have been some of those beaten down sectors last year that we've talked about a lot. Healthcare, energy's been performing a little bit better here at the beginning of the year. So we're seeing some rotation potentially in the markets, and the question will be, of course, whether that rotation is going to be continued. Is that going to be the new theme for the year? Or is this a temporary rotation that then goes back to those disinflationary trades for the markets, which tends to be technology, communications, discretionary, which tend to have the highest earnings capacity, and particularly as we look at earnings growth in 2024, expectations of those earnings, the vast majority of the growth in earnings are coming from those disinflationary sectors. So the question will be now, is this rotation we're seeing now, is that sustainable in a more disinflationary environment, if that is indeed going to be the case that lays out this year? And again, that's going to be a big driver of Fed policy as well, which we'll talk about with Michael Liebowitz this morning. That's what you need to know before the bell this morning. When we come back from the break, we'll pick up with Michael Liebowitz. Be sure and get by the website, and if you have not already gotten your ticket for our economic summit that's coming up on January the 27th with Greg Valliere, we're going to be talking about the presidential election cycle, the upcoming presidency, that election, what does that mean for the markets? How should you invest for it? What are the risks? We'll be going through all that, but get your tickets now. They are limited at the website, realinvestmentadvice.com. Just click the banner at the top of the page and you get your ticket. realinvestmentadvice.com. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valier with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valier. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. It's, of course, 6:17, and that means it's Thursday. Michael Leibowitz is joining us this morning. Of course, he's sweating because the Epstein files are getting released. So
I told my wife I wasn't on it, so we're good.
So did Bill Clinton. Anyway,
He told her a lot of things.
Hey, if it's just a cigar. Anyway, the issue is whether or not, I know, bad joke this early in the morning. Anyway, yesterday the Federal Reserve minute, the FOMC minutes came out from the last meeting, and the big question is what does that mean? For the markets. It was interesting because after those minutes were released, the markets actually sold off some more yesterday, and like I said, took out that. Unfortunately took out the Santa Claus rally. So we've completely erased that entire move over the last 5 days of December. But it was interesting as I was kind of reading through the minutes, there's still a lot of, I guess a lot of ways you can interpret the minutes as to what the Fed might be thinking or not thinking. And, but I think down at the end, at the end of the day, the markets remain extremely optimistic that the Fed is going to aggressively cut rates this year. And when you kind of look at the minutes, that wasn't quite that clear. And Micah, kind of what were your takeaway from the minutes yesterday? And what was that kind of, what was the thing that jumped out to you the most?
Excuse me. You mentioned it earlier. There was a little something about QT.
Mm-hmm.
To me, that was the one thing that really caught my eye, that they were talking about QT and the pace of QT, and that when bank reserves hit a certain level, which, they don't give you the formula for that or what they're looking for, they would like to start tapering QT. So not ending QT, but just reducing the amount they do every month. And that's the first we've heard of any reductions to QT. But again, there's no formula, but they clearly put this in there so that the thought would be out there. And this continues on since November 1st was when the pause was essentially initiated by the Fed. They kind of caught the market off guard at the November 1st or November 2nd meeting, early November, when they essentially told us the odds are highly favorable that they're done raising rates. Then the mid-December meeting came and they affirmed the pause. And further, they showed us that in their forecast, there are no more rate cuts, again, affirming the pause, but there were no more rate increases, but there were 3 rate cuts in their forecast. And that was not only are they pausing, but they're likely going to be cutting rates in the next year. And then in this one, they're starting to talk about tapering QT, and they really didn't walk back the market, right? The market, like you said, is priced for a lot more rate cuts next year than the Fed projects. So I thought that if they were uncomfortable with that, they would put some words in there that say, something like, we talked about cutting rates, and it seems like everyone's on board with cutting rates, but we think they could be at the very end of the year, maybe one or two. They could use language to push it out. They could, other things they could have said. So it's all a little strange to me, Lance, because on November 1st, Powell came out there and said that higher bond yields, lower stock prices, and a stronger dollar are doing the Fed's job for them, and that they don't need to do anything else. 6 weeks later, they come out, despite much lower bond yields, much higher stock prices, and a weaker dollar, saying that we're going to start cutting rates next year. Nothing economically has happened. The data continues to be strong. There's not really any weakness in the labor markets. JOLTS came out yesterday, giving us a little hint at what we may see with the BLS report on Friday. But other than manufacturing, there's no weakness. Inflation continues to steadily decline the way they want it to. So, there's who knows what's going on at the Fed. And we talked about this, I think, the last time that we were on air together, that whether they got the tap on the shoulder from the banks, the president, or whether they're truly concerned about something, we don't know. But clearly, the Fed has ushered in this no landing Goldilocks era that the markets reside in now.
Well, one of the reasons for that, we've seen a very big uptick in repo. In fact, what's going on in the repo market as compared to the Treasury, kind of the Fed's rate in itself is one of the biggest jumps we've seen since 2019. Of course, going back in 2019, we've talked about before is that the Fed, had been hiking rates, and they cut rates a couple of times, mid-year. And then in September, they had to really start fighting this whole reverse repo problem that was occurring. And we found out later they were bailing out hedge funds. But we're seeing that same uptick here over the last month or so. And, maybe that's that's kind of that first, hint that there might be something, brewing either in hedge funds or a major bank somewhere or whatever, that all of a sudden, these overnight lending rates are starting to clip up to, 5 and 6 and 7%. So, maybe that's part of this reason why they're remaining a little bit more reticent about pushing back. But, if you kind of go through the minutes, there was still a lot of indecisiveness in there between a lot of the participants. There's some that are saying, hey, we need to keep rates higher for longer. It doesn't seem like they even know for sure exactly what they're doing. They're just kind of hoping things work out at this point.
Well, I think you're right. I don't think they know what they're doing. But what Barkin, I forgot where she's from, but Barkin came out yesterday and said the Fed could raise rates still. That's interesting because we look at the dot plots for all the voting members on the Fed, or all the members on the Fed, and not one of them had a rate increase next year. Right. So at that meeting, she said that she projected the Fed was not raising rates, yet they continually come out and say that they could raise rates. So I think they do want to temper the markets, but they don't want to scold them, if that makes sense. Yeah. They want to support rising stock prices, lower bond yields, but they don't want them to get out of control in either direction. They probably want it to be more moderated, which they haven't seen. Right. The bond market has rallied, is one of the more historical rallies we've seen in the last month or two. Stocks were up, 10% in a month or two? No,
15% over 2 months.
I mean, those are massive rallies historically. And I think that's what keeps shocking me is that you would think the Fed would have backed off some of their rhetoric. Not that they wanted them to yields to go down and stocks to go up, but not to the degree they did. So, clearly the Fed sees something that no one else sees, and they're not really alluding or letting us on to what that is.
Right. Well, and again,
And I
maybe
guess we'll find
it's
out.
yeah, but this is again I go back to 2019 because you and I were having the same conversation back in 2019. The markets were, the Fed had hiked rates into September of 2018. The market had declined by 20%. Trump had scolded, Powell and threatened to fire him if he didn't stop doing what he was doing. And then all of a sudden, the Fed magically, and so, yeah, let's go back real quick. So in September of 2018, the reason the market sells off, Jerome Powell says, hey, we're nowhere near the neutral rate. We're going to be higher for longer, to put it in today's terms. By December, after nearly getting fired, he's like, "Oh, guess what? We're at the neutral rate. We're there." And they hadn't done anything. They hadn't raised rates any further since September, but all of a sudden we're at the neutral rate. So markets rally, and everything seems to be fine, right? Markets are rallying, bond markets are doing well, yields are coming down, stocks are going up, very similar to what we're seeing now. And then in July, the Fed comes out, starts cutting rates. And then you and I are having this conversation in September about what the hell's going on in the repo market. Why are people having to, put up collateral, guaranteed collateral for 10% overnight lending rates? And like I said, we didn't know then that it was hedge funds that were on the brink. But, it's very reminiscent. What we're seeing now is very reminiscent to what we were saying back in 2019. And, of course, 2020 was the trigger that pushed the economy over the edge into a recession. So is that going to be the same setup? Or are we just waiting for whatever catalyst it's going to be to to break the market?
Right. And Lance, there is one thing to think about. In March, the BTFP program that kind of bailed out the regional banks and the banks in general expires. Now, I had seen, and I can't find where I saw it, that they were going to let it expire, which means that if the Fed is really going to let that expire, they need yields to be lower. They've had some help, but they probably need them to even be lower, which then allows the loans and bonds and everything on a bank's book to rise in price, meaning that funding need decreases.
Right.
So that's, when you look out on the horizon of the potential things, obviously we could come up with all kinds of geopolitical stories and political stories, and we can just go back in history and find things that have cratered the market. But at the end of the day, the only thing that really registers over the next few months is that the BTFP program will potentially end. Again, they can turn it right back on or they can extend it, but if it does end, that does put the banks in a somewhat of a squeeze.
Yeah. And it's interesting, yields have come down, but, usage of that BTFP program hasn't really declined that much.
Well,
So
apparently there's an arbitrage there.
Yeah.
So they can actually make money using it. So I guess we don't know what it's true, how much of it is truly being used to help banks and how much is being used to make profits.
Yeah, exactly. But it could just be the latter. All right. It also may become one of those things that becomes a permanent fixture, as we've seen other programs become
Like
in the past as
everything
well. All right. Quick break. We'll come back, pick up more of the Real Investment Show with Michael Lewitz. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valier.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valier with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valier. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
What is it about teenagers that they cannot keep up with their chargers? I don't get it. I've had the same charger for like 100 years. I had chargers before they were even chargers, and it's the same one.
The Real Investment Show podcast.
Chargers and AirPods, whatever. I'm a Samsung guy. I'm with the other 75% of the population that has a real phone. Truth. Just speak the truth.
Just say it.
At realinvestmentadvice.com.
If you want to know the truth, listen to this show.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Michael Leibowitz joining me. It was interesting. I went hunting over the holidays. There's an article out on Wall Street Journal this morning talking about SpaceX moving into cell service. And while we were out hunting, of course, we're down by the border between El Paso and Laredo. And, we're out there in the middle of nowhere, and there's no cell service out there whatsoever. But they had one of these little StarLink satellites with them, and so they could just throw this little StarLink satellite up, and we had internet service, whatever we needed, right in the middle of nowhere. And Starlink, and so it's very cool technology, and it's very neat. And Starlink is projected to hit about $10 billion in sales this year, and Musk is reportedly talking about spinning it off in a separate IPO this year. This could be huge, and particularly if they get into cell service and tech service as well. This could be quite something to watch. So anyway, very neat technology. All right, sorry, I digressed. Okay, so over the last couple of days, this market's been kind of selling off, and the big pressure on the sell-off, as we said earlier, has really been in the big mega cap techs, which were the biggest drivers of the markets last year. We had numerous conversations last year about the market, and that 10 stocks were basically creating a significant amount of returns. In fact, for the year, the top 10 stocks accounted for 75% of the total return of the index last year. So yes, finally the bottom 493 stocks actually played a little bit of catch up into year end, and we did see a bit broader rally in November and December, which was healthy. But even with that, it wasn't enough to make up for the majority of the gains that were driven by just a handful of stocks. And the question now is, of course, we've seen a bit of a rotation early this year so far, money coming out of those stocks, going into some of the more beaten up sectors of the markets. We've seen healthcare do better. We've seen low volatility stocks do better this year so far. We've seen energy stocks do better this year so far. The question now becomes, is this going to be a permanent rotation? Is this going to be a year that laggards outperform? Or is this just a temporary issue that we're seeing some rebalancing, some tax gain selling for the year? Because as a portfolio manager, I can sell stuff now, take the gains, and not pay taxes on it until 2025. So there's some of that going on. But, is this a temporary shift, or is this something more just temporary that will, kind of go back to the way it was before? And that's going to be the big question now over the next month or so as people try to get their portfolio aligned for what the outcome of this year is going to be. Mike, what are some of your early thoughts on this?
So I actually wrote about this a couple weeks ago, and I was on with Charles Payne right after that, and we had a little discussion because my article talks about the NFL and how there are very few repeat Super Bowl champions, how there's always kind of a new crop of most favored teams. Like this year, the Miami Dolphins all of a sudden are favorites. And some of the teams that, like the Bengals, aren't going to make the playoffs. You go back last year and you would have said the Bengals are definitely going to make the playoffs, and maybe the Dolphins will be okay. Charles is a Jets fan. I'm a Commanders fan. So we both, as basement dwellers, it gives us both hope that our teams will rise to the top in the coming year. Stocks are somewhat similar, that the stocks that do well, the sectors that do well in one year aren't always the best sectors the next year. Sometimes there are repeat champions, but oftentimes the market rotates between sectors, between factors. Even asset classes rotate. So what's in vogue one year is often not the top performer the next year. So last year was obvious that market capitalization was the key driver of returns. Large cap was far and away the outperformer, the Magnificent Seven, the 10 that Lance mentioned. That's what drove the market. The last couple months of the year was a little healthier with some of the other stocks catching up a little, but that was a predominant theme. So the question is, as we look forward, which sectors, which stocks, which type of stocks, which assets will outperform and underperform? So again, we're always looking at our rotations, but they don't, just because the calendar changes doesn't mean that the rotations just change because it's 2024 now. So, I really try not to read too much into what went on in the last 2 weeks of the year and probably what's going to go on in the next week or so, because there is a lot of illiquid market conditions. A lot of large investors are out of the office. And at the same time, there's a lot of year-end trading that goes on, tax loss selling, rebalancing, window dressing. And when you get into the new year, some of that gets reversed. So, for instance, let's say someone didn't like bonds, but they didn't own bonds all year. They didn't like them. They had a good year because bonds sold off and they weren't involved. But they get to year end and bonds have done really well for the last month and a half. And they say, you know what? I want my clients to think that I've held bonds for at least the last quarter. So they buy bonds going into year end. Well, now here we are in January, and they may very likely say, you know what? I still don't like bonds. I know they've had a good rally, and my customers think I own them, but I'm going to get rid of them now. And if I have to buy them back before the end of March, I will, but I'm going to sell them. So you get a lot of reversals of some of those trades that happened in December. And that is, I think, what's going on now. And we've kind of seen it. The best performing sector has been small cap over the last couple of weeks. Large cap, we look at how the markets performed this year. NASDAQ is the worst, S&P in the middle, and the the Dow Industrials is the best performing sector. That's a complete reversal of the rotations we saw last year. So again, the market will rotate at some point. Maybe it's starting to rotate now. Maybe what we're seeing is the equal weighted, the value, the underperformers, the utilities, the staples, the healthcare. Maybe they're going to take charge, and maybe it's going to just happen to start on January 1st. But I would give this a couple weeks, and let's see. We have rotation models. Let's see if they start picking up on any kind of strength that's durable versus a nice run for 2 or 3 weeks before the Mag 7 just take control again.
Yeah, and this goes to a whole variety of different issues. And is it just the Mag 7, or is a lot of talk about international and emerging markets valuations are cheap relative to the U.S. And there's been a big push for the last couple of years, really last 10 years. People have kind of continually talked about this relative cheapness of international relative to domestic stocks, but it's been a very bad performer on a relative basis. I mean, if you've had money in international and emerging markets over the last decade, you've significantly underperformed domestic exposure. And so, every year we kind of start this year is like, well, is this the year that, whatever it is going to be, this year's outperformer? And it is. And it's always tough because, if you go back to 2021, as an example, energy was the worst performing sector. Of course, energy prices had gone negative, and energy stocks were under pressure because we were doing ESG and we were going to get rid of fossil fuels. And so going into the end of the year, nobody wanted to own energy. And next year, it was by far the best outperformer in 2022. Same thing in October of 2022. Technology stocks had a big correction. We wrote an article talking about are FANG stocks dead, and we made the argument that if we start having disinflation, they were going to be the best performing sector. And that turned out to very much be the case. And so now this year is going to be the next big question. Is it going to be a year that the laggards overtake the leaders? And again, we don't know that yet, but it's going to be something very interesting to watch unfold.
Right. I think it's important to have expectations about what may or may not happen. But at the end of the day, we have to read the tape and let the market tell us what it's think. Because regardless of whether we think there's going to be a hard recession or just a continued very robust economic growth, it's hard to know what will perform. We talk about narratives a lot. And at the end of the day, the narrative drives the market over the very short run. And if that narrative is this Goldilocks, no landing scenario where stocks go up, bond yields go down for the next few months, so be it. That's the narrative, and that's the market we need to be involved in. And that narrative will change. And when that narrative changes, those sectors and those stocks and those factors that lead the way or lead the way lower will emerge, and we'll see what they are. And the key is to try to catch some of these rotations early, but don't fall for false signals. And that's where it gets very difficult, but that's our job, Lance. And I think we got another tough year ahead of us.
Yeah.
As the narratives in these markets have been changing quickly and rapidly. Mm-hmm. And we got a very unique economic environment that we're dealing with that we've never really seen anything like this. So we got a lot on our plate.
Absolutely. All right, we'll take a quick break. We'll come back and get ready to wrap up the show for this morning. Be sure you get by the website and make sure you get your ticket for the upcoming summit that we have on January 27th. Mike will be here to talk all about bonds and interest rates, the outlook for the year, what to expect. So we'll be covering all that, so much more. You certainly don't want to miss it. It's January 27th, starting at 8 a.m. in the morning till noon, and your tickets are only online at the website, realinvestmentadvice.com.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valier.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valier with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valier. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN. RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
You know, some years ago, there was a big move towards this cutting the cord, as they say. And Brent and I were actually talking about this is like, you know, how long is it going to be before people start realizing that they need to go back to cable? Because once everybody starts jacking up their rates and you have more, you know, everything's becoming a fee base now, right? You know, if you want to read an article online, you got to pay for a subscription to the New York Times or the Wall Street Journal, the Bloomberg. Everybody's going to Substack now. Everybody's going to be writing their own newsletters, so you have to go subscribe to their Substack. And again, it's all fine and dandy, right? And you know, it's even interesting. Like Rocket Money has now come out with an app that will track all your subscriptions, because it's just people are getting feed to death. And you sign up for this, you sign up for that, and you know, you don't really think about it much. It's just, hey, just throw in your credit card information, and all of a sudden you got access to whatever it is. And you know, you start kind of looking at your you know, your bill at the end of the month of all the different things you're paying for, and it's, you know, $5 here, it's $7 there. And at the time when you sign up for it, it doesn't really seem like that much money. It's like, $7 a month, you know, whatever. It's like, you know, I spend that on a cup of coffee at Starbucks, but it all starts to add up. And when you have, you know, a subscription to this and that, the other thing, all of a sudden these things start to add up a lot. And you know, millennials are now starting to, and Gen Zers in particular, starting to ask the question is like, where's the value, and why can't I make ends meet? And it's because all these things that they want access to is now costing them a fee. And I thought this was interesting. There's an article this morning, a company called Antenna did a survey of streaming services, and they asked people, you know, how do you feel about your streaming service, particularly because, you know, Netflix has raised their rates. You know, they're up to $17.99 a month now, and HBO Max and Disney and Hulu and Showtime and at CBS and Paramount Video if you want to watch Yellowstone, right? You gotta have the subscription. Disney Plus, Apple TV, everybody's got a streaming service out now. And so when you start adding all these things up, all of a sudden you're spending, you know, a good bit of money every month, and you also have to pay for access, right? You got to have cable, right? You got to have the internet, so you got to have somebody provide it for you. Verizon, and one of the stocks that we've, you know, liked for a long time in our portfolio is Comcast, because they just gin out cash flow every year, because you got to pay for the internet connection at least. But now, you know, the question is going to become at some point, and we're now starting to get this, and this was in the Wall Street Journal. A new report from Wall Street Journal cites data from subscription analytics provider Antenna that shows customer defections across streaming services topped 6.3% in November, up from 5.1% a year earlier. Antenna said about 1/4 of U.S. subscribers to these major platforms, also including Discovery Plus, Max, Paramount Plus, Peacock, and Stars, have canceled at least 3 subscriptions in the past 2 years. And one of the people they interviewed said, I'm starting to, his quote, with the streaming services increasing their rates like they are, it's like, is it time I start paying for cable? In other words, this has been one of our questions for a long time is that when does somebody get smart and go, you know what, I'm going to bundle all this stuff back together. The whole point of cutting the cord was to unbundle everything and get just what you want, a la carte. And now people are going to start asking the question, is it going to get cheaper to start going back to the bundled services? And Comcast and companies like that, Verizon, that provide the actual internet connection, can also provide the bundle at the same time at a cheaper rate, and they can do it through the power of that. And so this could be a bigger win for companies like Comcast as that realization starts to kind of take hold here in the economy. Mike, any thoughts on that?
Yeah, no, I think that's right. I have a good friend of mine who is, both of us we watch a lot of sports. We want to watch our local teams, but other teams as well. He just went to, I think it was YouTube TV, but it may have been one of the other ones. And he said it's about the same price, and he said there are benefits to it. It's nice the layout and everything, but he said it's about the same price as cable. The reason he did it is because he has a house here and then a house by the Chesapeake Bay. Mm-hmm. So he can run 2 houses off one subscription. So that makes a lot of sense. But for poor schlubs like me that have one house, cable still makes, seems to make a lot of sense. And you don't have to deal with the lags, the router being down, and some of the other things that come with the internet TV.
Right.
I've been tempted, but Lance, you were talking about the subscriptions, mm-hmm. and I wonder if that's going to become over time, if we can get good data on it, another leading economic indicator. So when you're going into a recession, for instance, will people start cutting back on their subscriptions? When things are really good, will people add to their subscriptions? So that may be something that we're talking about in the years ahead, the rate of change in subscription services.
Well, it's a great point, Mike. And it's something you and I have talked about here on the show before. Is that we have so much real time data for stuff, right? I mean, to call up Netflix and say, okay, give us all your data on how many people this month subscribed to your service, how many people dropped off. We know that data, right? And we get that from all these companies. We go to ADP. How many people got a job this month? How many people got fired, laid off, took parental leave, et cetera? They have that data because they're processing the paychecks. And yet, from an economic standpoint, we're still flying blind by the seat of our pants using telephone surveys and using all these these mathematical adjustments to try to account for things that we have real-time access on. How many people started a business a month? We know that. There's actual data that shows you how many people applied for a business license over the last month. We have that data, yet we do things like the birth-death adjustment, which is a complete fabrication in the employment report. And it just baffles me. And you've got, and here we've got the Fed, trying to make these big, massive monetary policy decisions based on, actually very poor quality data. There was a time, I get it, back in the 70s and 80s, that was the best we could do. We could do so much better now with our economic data because it's available.
Right.
It baffles me.
I laugh, Lance, because we have the ADP report is going to come out today in about a half hour or so. That report is based on actual data that they've collected from businesses. No one's going to look, assuming it's ho-hum, no one's going to care. No one's going to say anything about it. The BLS employment report comes out tomorrow at 8:30. If it's off by 20,000 jobs, more or less, everyone's going to say, wow, the job market's doing great, or the job market's really slowing.
Yeah.
It's all based off a survey that doesn't, even when they, first of all, you're assuming that people answer the question, the companies answer, or the people that they survey answer the questions correctly, but it still doesn't account for things like multiple jobs and the fact that they're surveying such a small percentage of the population of either companies or people, and that the unemployment rate is based off a survey of individuals, and that the number of payrolls being adding, which is kind of the bigger number, is based on companies. I mean, it's just fraught with potential problems. And we have ADP. They're going to tell us the number today. You would think that would be the gold standard, and then we would all just kind of look at Friday's number and laugh and say, yeah, that's cute. That almost got it right.
Yeah, you would think that would be the case, but it's exactly the opposite. And another big problem with these government surveys that we do, like the BLS, we call up 60,000 households. First Tuesday of the month, that's how that number gets put together. It's like, hey, Brent, are you working? He's standing in his living room amid pizza boxes in his underwear. Yeah, I'm working. I work from home now. So, all right, Brent's employed. But no, that's the kind of data we're coming in. But even the number of participants in those surveys have declined sharply over the last 10 years. And you even have to ask about the veracity of the survey itself, not just from the simple standpoint that it's kind of a clunky system of calling people up and asking them if they're working, but you have such a low participation rate in a lot of these surveys, you really have to start asking about the statistical validity of that survey relative to a population of 300 million people.
Right. Well, I mean, when they survey a business, how much does the person that's being surveyed actually go pull down all the data and give them an updated number? Or do they say, well, we had 100 employees last week. I think we fired 2, we hired 3. Let's just call it 101.
Yeah. Exactly.
When it could be 105, it could be 95.
Yeah. No,
I'm sure
that's right.
A lot of that goes on too. They're estimating.
Yeah. And to your point, we put way too much way too much importance on some of these economic data points that probably we shouldn't. But that's what it is.
And the market does. We do because the market does. If the number is just slightly off in one, especially the employment report, the CPI report, and probably to a lesser degree these days, the retail sales report. If those numbers are off slightly in either direction, you can cause big market moves. And you can also, and this is probably more important, this gets back to what we were talking about, you can change the narrative. So hypothetically, if unemployment goes up to 3.9, 3.8 tomorrow, I think it's supposed to go to 3.8. Let's say it goes to 3.9, and then next month it goes to 4.1%, then the Goldilocks narrative is out the door. Now we're talking about whether it's going to be a soft landing or a hard landing again. What kind of how bad is the landing going to be? Should we brace? Should we make sure we have our lap belts on? So, because of these faulty surveys, that's going on, you can really change the mood of the market, the sentiment, the narrative that's driving markets and driving stocks.
Absolutely. Mike, thanks so much. All right, that wraps up the show for the day. Be sure and get by the website, get signed up for the Economic Summit on January the 27th. And if you're not a parent but thinking about becoming one, a good way to prepare yourself for parenthood is to talk to Rocks, because they have similar listening habits to children. And I can attest that as a true statement. So... All right, y'all have a great day. Be back here tomorrow with Danny Ratliff and Richard Russo for Financial Fitness Friday. Get by the website. New blog posts are out, of course, from Michael Leibowitz, myself, on the website now. January resolutions, talking about the markets, what to expect for 2024. All on the website now, realinvestmentadvice.com. See you back here tomorrow.